All right, let's move on. So yeah, we're basically talking about other things we're going to look into after we look at this major, which will be the fundamental analysis. And then we'll look at number 2, correlation. Very important topic. And then number 3, we'll look at cross-referencing. Right, so this is what we'll do in the next 3 days. So if we are okay with this, then I'll have to go straight into the top-down analysis, right? Which usually is my 2-hour or 4-hour, right? So when I am trading, I want to do my analysis in the monthly time frame, putting the market in 1,000 pip range. But there's a specific way or specific model in which I come by determining that 1,000 pip range, right? There's a systematic way that I follow to pick out the 1,000 pip range. I don't just wake up and then draw the 1,000 pip randomly from anywhere at all. I use specific rule or specific strategy to pick out those levels. So if you look at this, we're currently looking at USD Swiss franc. I intentionally picked USD Swiss franc just so it would make so much sense and clarity to you guys, right? So prior to this, 2 lines you're seeing here, right? So try and ignore these. Try and ignore these. Hold on. Try and ignore these 2 lines here, right? Let's focus on here. So here. So prior to these 2 lines, right? This was how the market was. So if you're looking at top-down analysis, you want to look at the most relevant range in which the market has been trading in, right? So this basically is the most relevant range in which the market has been trading in, right? It has traded beyond this though, but I intentionally cut that side off so that this one will make sense in seeing what I want you to understand when it comes to the top-down analysis. So if you put USD Swiss franc on a monthly time frame, you're going to see something like this, right? And then if you watch what is going on here, you can see that the market sort of started from this side, pushes up, trades up to this point, retraces. There's a big spike down here. I don't know what may cause that. Pushes back up again, taps back here, up, down, basically just what ranging, right? Goes all the way up, ranges, and then taps from this point again, and then pushes back up. So in looking at this, you can clearly see that what we have some level of what support levels and then some level of what resistance levels on the monthly time frame, right? Using the wicks as the support and then wicks as a resistance. Here could be what a support, here's a support, here's a resistance, here's a support, here's a resistance, 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 support, support, right, on a monthly time frame. So if you look at, like I'm saying, most relevant ranges in which we are looking at or which we are concerned, here is the most recent support levels in the market, right? This one, this one. So in terms of 1,000 pip range calculation, we want to look at the most relevant support level, right, that the market has tapped on or respected quite recently, but also around a psychological number or a round number, right? So this is how you would have been looking at the chart if I didn't have my levels there. This is how the market would have looked like. Basically, raw, no lines there like that. So what I will do is I'll randomly throw a horizontal line around these levels, right, to see which psychological level or which number, round number, comes close to this level. And then once you throw a line there, you can see that it comes close to what? 0.9200, right? So I always start the top-down analysis or the 1,000 pip calculation from the support level all the way on the upside. I don't do it from the resistance level. I start from the support level using the wicks as my support point of picking, right? So here is where I'd be interested in looking at this and say, okay, here comes very close to what? Tapping into 0.9200. Again, here tapped into 0.9200. Again, here was flirting around 0.9200. And so on and so forth, all in a monthly time frame. So 0.9200 becomes my monthly support. That's why you see MS, me written the little MS, right? So that MS you're seeing there basically represent monthly support of what? 0.9200 for USD Swiss franc. The only thing I do next is what? To calculate 1,000 pips from the 0.9200 on the upside, right? Wherever it may want to go, I don't care about that. So you can use your calculator to do that, or you could also use this measuring tool here to do that. So if you stand here 0.9200, then you stretch up, you can see that 1,000 pip is about 1.0200. That would make 1,000 pip from 0.9200, right? So you can use your calculator to do that. You can use the measuring tool to do that, and you realize that 1.0200. So now you can see that we've chosen between 0.9200, 1.0200 as our most relevant rate to be interested in, right? 1,000 pip start from what? 0.9200, which is bottom here, to 1.0200, right? That becomes our first step, right? All you do is throw a horizontal line. You pick the horizontal line from the tools, right? Here's where you get a horizontal line. You come here, you pick this horizontal line, you throw it in there, I'll show you how to do that, right? I've already marked up my own, so it wouldn't be possible to do that. But all you have to do is just pick it like this, right? Throw it in there, double click on it. It's going to give you coordinates. You choose specifically 0.9200. They come to the text, and then you want it to be at the bottom, you want it to be at the right, and then you can now type in the coordinates there so that you can easily see that you're putting the line on 0.9200 as monthly support 0.9200. That's basically what I do, right? That's basically what I do. So that when you do that, so you double click, like I said, you double click on the middle. It's gonna bring this one, then you can do the rest, right? You can do the rest. Now let's go on. So once we have 0.9200, we label it monthly support. Then 1.0200, we label it monthly resistance. That becomes our monthly resistance, right? Now that's what you're going to see MR, me labeling it as MR, representing monthly resistance of 1.0200, right? Monthly resistance of 1.0200, right? So after I do that, then what do I do next? I still go to divide it into sub-sections, right? Or sub-levels. I don't just end there. I go on to divide them into sub-levels. Remember, we're using USD Swiss franc, right? I'll tell you how the other ones have played out as well, though. So currently, we're just using USD Swiss franc for our analysis, right? So what do I do next? Now I know that from here to here is 1,000 pip, right? From here to here is 1,000 pip, but I want to do something next. I want to divide it into equal halves. You can again use your calculator to do that. 0.9200 plus 1.0200 divided by 2, I think you get something like 0.9700, right? Once I get that, that also becomes a weekly level for me, right? I label it as a weekly level. It could be weekly support, it could be weekly resistance, but all I do is that I divide the monthly level, I add them and then divide it by 2, then I get this midpoint here, which is going to be a 500 pip half, right? So from here to here is going to be 500 pips, and then from here to here is also going to be 500 pips, right? I'll show you the reasoning behind that, right? It's not like we're just doing something that doesn't make sense. I'll show you a clear reasoning behind that. So after I do that, then what else do I do? I also go on to subdivide the 500 pip into 2, right? So take this one, that is 0.9200 plus 0.9700 divided by 2. You're going to get a figure which will be around here. I can't tell exactly what that figure will be. And then once you pick 0.9700 plus 1.0200 divided by 2, you're going to also get what? A subdivision here. So eventually, this is how your chart is going to look like. Something like this, right? With 250 pip equal halves, right? 1,000 on the upside, 500 in the midpoint. When you divide the 500 into 2, then eventually we have 250 pip on equal halves, right? Now let's look at the reasoning behind that. If you look at this, you can clearly see that indeed, when I chose a monthly support of 0.9200, you may want to ask yourself, why did the market decide to tap exactly on 0.9200 and then reverse, right? These are big players, footprints of big players, right? Or footprints of institutional traders, right? You know that the market is predominantly controlled by hedge funds, financial institutions, and then central banks and big corporations that deal in the currency market for various purposes, basically for transactive purpose, for hedging, for speculation as well, right? And then because they have a lot of liquidity, which specifically is cash, and then information, they are able to move prices in the direction in which they want. And then they also do that not just randomly, the way retail traders do, as in anywhere at all we want to buy or sell any currency based on some indicator giving us some decisions or some strategy that we learned from YouTube or whatever it is, right? These people trade basically price, and then they always want to bargain for good prices in the market, right? And they know exactly what good prices are. Remember that in trading the currency market, you're trading in an exchange market, and then these prices you're seeing here represents the exchanges, right? These prices you're seeing here, so they are not just random, right? Wherever country you're coming from, if you're from Ghana, if you're from Nigeria, just look at how your exchange rate is pegged against the dollar, right? And then look at how the fluctuations affect transactions in the economy. But it's the same thing that goes on here, right? If you're a currency trader, I consider you a global leader in terms of information. Why? Because before those news agencies, before Bloomberg, before Sky News, before Al Jazeera, all those people are going to come on their news website and then be announcing oil prices is here, gold price is here, USD, GBP USD is here. You already know them, right? Because that's what you're dealing with. That's the currency you're trading, right? Except, of course, you don't take priorities in the exchange rates, then you wouldn't know them. Because at the end of the day, these people take the information, the live information that is going on here, and then broadcast it for the rest of the world to see. So you, as a currency trader, you have an upper information than the rest of the world, right? That's one thing you should also know, right? Gold prices are always picked from here. Oil prices are picked from here. The NASDAQ, the US 30, they are not picked from anywhere. They are picked from exactly what is going on based on what the exchange rates you are seeing here, right? Based on the exchange rates. So then again, it tells you how competitive these big players always want to find a prime level of entry or accumulation or whatever you want to call it, right? Remember again that these people are not scalpers, they are not day traders, they are not swing traders, they are position traders. So who is a position trader? Position trader is somebody that holds position for usually more than a month, right? It could be a month, 2 months, 3 months, 6 months, even a year, right? They hold their trades for a long time. Why? Because of their liquidity, right? They are trading millions and billions. They cannot be winding and unwinding their positions anyhow, unless, of course, it's a major level that they anticipate what a total reversal in the exchange rate before they would start unwinding their huge positions in the market. But retail traders, we are trading with $1,000, $500. You can easily come in and come out. They can't come in and come out. So they are usually position traders. They hold their positions for a long time, right? So that's why they would want to use the monthly time frame as a good perspective to determine the overall direction, and then they want to jump in. So they don't care about pullbacks or retracements in the lower time frame, which is like 5 minutes, 10 minutes, 15 minutes, whatever. Even in the monthly time frame, pullbacks, they don't even really care about that because they know they have the liquidity to push price in the direction that they anticipate. But my strategy only looks out for the footprint that they leave behind after what they do, right? So it's not like I have an insider information to tell me that here's where the market is going to reverse or here's where the market is going to turn or not, right? But I use the footprint based on the knowledge, based on the information that I'm giving you, according to how these big players control the market, to also look at key zones to tell where could likely be a reversal point, likely be a continuation, likely be a swing point. Then I jump in, and that is what I have been doing since, to catch entries at the very top of the market or at the very bottom before a swing point or a trend begins, right? So if you have followed through what all I've been saying from the beginning, then you should clearly understand how I pick my levels. Usually you'd always see my market divided into 4 regions, which is what 250 pip range, 1,000 pip first, then the 500 pip followed, and then the 500 pip are divided equally into halves. Then I have what 250 pip. That is the first analytical process I go through. After this, I don't delete them. I leave them there as far as the market keeps trading in that range. So as far as the market keeps trading in this range, there's no point in always wake up the next day that you'll come to do top-down analysis again, right? So most of my top-down analysis, they've been on my chart for so many years, right? Some have been 2 years, 3 years. It's the same level that I've used, because imagine that you drew this thing and then this market, you drew this thing from here, and then this market has been trading in this region since yes, as far as 2016. So you can see that from 2016, 17, 18, 19, 2020, this pair, which is USD Swiss franc, has been stuck in this 1,000 pip range, right? So there's no need to just adjust it as far as this market is still trading in this, unless, of course, the market trades out of this range. Then I'll do 9 bits of what adjusting and maybe adding a 500 pip more, right? Which would be like maybe calculate 250 pip down, 250 pip down. Or if it decides to really extend downwards, then I calculate, adjust even some more, which is what, another 1,000 pip, right? So if you look at most of my currencies, especially the pound pairs, I've adjusted some about 2,000 pip, 3,000 pip, because the pound is very volatile, Brexit and all that is going on. It trades out of my range, and I have to quickly adjust it and follow the same rules to analyze the market. But for these ones, they have done their bit in sticking in the range, right? So now I'm going to pause and see what you guys think about in terms of the what I've showed you. Whatever you don't understand, whatever you want me to emphasize on again, you can quickly type it out in the group chat. I'll be watching it quickly, right? I'll be watching it quickly. Whatever you want me to talk about again before we head on to the next thing, right? About the top-down analysis. This is Euro Japanese yen, right? So if you look at Euro Japanese yen, you can see that prior to even this movement here, my 1,000 pip was picked from a range like this, right? I was using this one prior to this big dip here. I was using these levels. Calculate somewhere here, you draw the horizontal line, calculate 1,000 pip from there, wherever it's going to get to, right? And then you divide it into 2, But with all this that I'm saying, I'm going to tell you something next, and then divide it again. Then eventually I have what 1,000 pip divided into 250 pip equal. So if I take these lines off, this is how uh, my Euro Japanese yen chart look like. You can see that the monthly support is what 116, and monthly resistance is 126. The division is what 121, and then the daily support is what 118.50. Daily resistance is 123.50. Right. So as far as this market has been trading in this ring, there's no point in what adjusting or readjusting. You can clearly see that what just last 2 months it traded onto the monthly resistance and then started reversing, right? So I would not know why the market decides to use this point as a resistance level, but it's just how it works, right? So it tells you what the footprint of how these big players play around, right? These levels, remember, they were there before this market traded here. It wasn't that anytime the market get there, then I adjust, right? So I always leave them there. As far as the market is trading within the range, then I leave them there, right? Let me see. Somebody says, is it extremely necessary for the range to be 1,000 pips? Yeah, it is actually necessary for it to be. You can just draw any random pips. How can you use Fibonacci for the division? You can use Fibonacci for the division, but you're not going to get the exact pinpoint. So I don't really advise that people use Fibonacci for the division, right? Something like this. If I pick my Fibonacci tool, what's my Fibonacci tool again? If I pick my Fibonacci tool, I could stand here, right, and then drag onto this one, and I would know that the midpoint, which is 50%, is equivalent to 121. But you're not going to get the exact price point, right? You may not be able to place it on the exact price point. I want you to have that specific 121.00. So it's best to use your calculator to do that, right? But yeah, that's how you can use Fibonacci to do that. And then when I divide the 500 into equal halves as well, you can see that it will sit exactly on the 50% again. So that's how you can use Fibonacci to do that. But like I've said, I want you to have the exact pinpoint. But again, what I wanted to chip in is that I have been doing this lessons for a long time. And so because of that, students usually want me to help them with how I plot my levels. They want to have the same levels as me. So I have a group where I forwarded most of my trading levels, right? And after this session, I'll just send out the link to you guys so you can join. And all the levels are there for all the currency pairs that I trade. So you can watch and plot the same levels and then do your analysis according to those, right? Let me look at some of these questions you're coming up with again. Why don't you use a weekly time frame to draw the weekly support resistance? How are you able to know weekly support resistance level on the monthly time frame? All right. So we're looking at what the market ranging from what a huge difference of what 1,000 pip. And then remember that what we are doing is a top-down analysis from the higher time frame to the lower time frame, right? All these things that we've done here, eventually we're not even going to be taking our trades on the monthly or on the weekly, but we're just using them as a basis to find what a broader or clean way in which the market is going to be traveling between our ranges, right? But from experience, once you draw the monthly range of 1,000 pip, right, the midpoint, which is usually the 500 pip, acts exactly as a previous weekly level becoming a support, or a weekly level now changing into a resistance, right? Once I lower into the lower time frame, you'd understand it. But that is just part of the rules. The midpoint, which is usually the 500 pip range, acts best as a weekly level. Also, is also somewhat to differentiate any point at time in which we're trading in the market, right? If you divide the weekly, if we're supposed to label all of them monthly support, monthly resistance, monthly this, is going to be difficult to tell where we stand in the market. So it's just an aspect to also tell us where we're standing in the market. The same with the daily as well, right? So they don't really make insane difference with respect to their labeling, but you just have to know how to pick those levels and then how to react anytime the market trades close to those levels, right? In drawing the monthly support, you use just the recent lows, two lows, right? Yes, I do that. Can you go over how you select monthly support again? I think I just did that. If it is bullish, we anticipate the reversal at just 1,000 pip range. You don't necessarily expect the reversal at 1,000 pip range. If you're asking this question, it means that you may think the 1,000 pip is a holy grail. The 1,000 pip is not a holy grail. It is just a range in which we are trying to anticipate possible reversals in the market. And this is not just what we're going to look at and say we're going to sell here, we're going to buy here. This is just one aspect of four, right? Or five actually, right? One aspect of five things we'll be doing. This is just one aspect of five things we'll be doing, but this is just to give us a basis, a body of clarity in where we're standing or what we're doing in the market. So this is not any major thing in what we're going to be doing. This is just one aspect, like I said, of five to give us a clarity of where we're standing. Because remember that with respect to what you're seeing now, imagine the market, right, to keep trading all the way here, right? If the market keeps trading all the way here, right, and then you don't have these levels here, right, trust me, you would never, or it would be very difficult for you to know that we've come to a very pinnacle point of this market, which is what the lows, the last lows. And after these lows, you can see that there may not be predominantly any support level beneath this range again, right? But because you have these levels, then once the market comes here, then you're seeing that you can tell that this is what the very last lows within the relevant time frame in the market. And then once we break here, then we could have what, a free fall or something. You get it? So it also guides you to know exactly where you stand, just like I said. So if we look at USD, USD Swiss franc again, if we look at USD Swiss franc again, yeah, just like you're seeing, once we're here, I knew that this was what the very lows in the market. Hold on. We're here as the very lows in the market, the very lows in the market. So when this candle got here again, I knew that we're at very low. Is this market going to hold here and push back up like it has done? Or is it going to break? This time it did what? It broke through and then pushed back up, and then it's still currently trading. So obviously I knew from the way I've drawn my levels that with the market coming back into this range, we are at the very lows in the market from like the year 2016, right? From the year 2016, this was a very, very low in the market. Right? If the market trades all the way up again and then gets to 10200, you obviously know that what we are at the very highs in the market, right? And they are very strong points for reversals in the market, right? Because it's not easy for the market to pick out monthly levels like that unless it has tapped on those levels for several times, right? Somebody says they can't hear. I think it's from your PC or something like that. It wouldn't obviously be from me though, because the others can hear. When the market makes a new low, yes, we adjust the levels, but you don't change them. You just add levels to build them up. You just add levels to build them up. Yeah. So basically, after we've done this, then we can appreciate how the market has played around these levels in the weekly, in the daily, in the 4-hour, whatever time frame we would be predominantly looking at, right? So it's the same thing that I've done for all my. So if you look at this, this is Euro JPY. I told you how we traded above this range and started rejecting on the 126, which has been their monthly resistance, right? And then now we just traded back into the range again, right? So you can see that throughout this month, the market basically traveled 1,000 pips, right? It's somewhat surprising how it reacts around my levels, right? 116 trades all the way up to 126 and then reverses back again, right? I cannot tell you that I have some magic potion to define why the market is doing that, but all I know is that it does work, and that's why I keep using them. If I am on the monthly time frame for all of them, then you can clearly see how I've drawn them, right? These are some of the ones that have traded outside the range, so I keep adjusting them, and then you see so many lines and so many levels, right? But like I said, I posted all of them in the group, so you can. I started using these levels like all the way back. So some of these levels for USD, for GBP USD, the relevant range was here, 1,200, right? 1,200 to 1,300, and it traded out of 1,300. So for a long time, I was just using 1,200, 1,300 for the range because it was trading from here, up here, went back up. Here is 1,200. But once it started trading above this range, then I adjusted these levels just in anticipation, right? And then you can see that what, even though I adjusted them just in anticipation, the market finds some way somehow to also still respect what the adjusted levels, right? After I broke 1,200, which is here, right, I adjusted what 500 pip down. It went all the way up, came back down, and then 500 pip down, it tapped exactly on what 1,500 before it pushed all the way back up, and then you can see that it came close to what 1,300, which was an adjustment from the 1,300, right? You can see that that's also what another 500 pip, and this is also what another 500 pip. You see that this is what this is a 500 pip, this is a 500 pip, this is a 500 pip. You get it? So now you can see that it's 1,000, 2,000, 2,000. What's it? 1,000, 2,000, 2,500, basically. But yeah, just the division. So it was picked from what one? It was picked from 1,200 to 1,300. So I was looking at the market in this range because I did this thing at the time when the market was trading within the relevant range of what 1,200 and 1,300 until it broke to 1,300 here, and I adjusted it, and then I had what 1,500. It traded back into the range, went all the way down during the Corona. I think then this thing broke all the way down. I adjusted it again, tapped again onto 1,500, pushed up. So you can see, right, how these market finds a way of playing around these psychological levels, as I would want to call them, right? You can see how it's just kept playing around them. So it's the same for all of them, right? It's the same for all of them. But when we come to certain instruments like gold, then it's different. I don't do 500 pip range for gold. I don't do 1,000 pip range for gold. What I do for gold is I use price intervals of a 500 pip, right? I use purely price intervals of 500 pip. So it is not a succinct calculation, but I use psychological numbers in doing that, though, right? Using the same preamble for the monthly levels. So if you look at gold here, we're trading around 1,200. This was when I started analyzing gold this way. So 1,200, 500 pip from there is what 1,250, 1,300, 1,350, 1,400, all the way to the top, right? Is 500 pip. That's just what I do with gold. So I don't do 1,000 pip with gold. And then why I do that is that I realized that gold has a very succinct way of playing around or trading with it. So every currency pair, as a trader, you must understand every currency pair has its own characteristics, right? And then with experience is how you come to identify those characteristics. You don't just wake up and then come to identify them, right? So because I was trading gold for a long time, I was back testing, I was seeing how it reacts around certain key levels, and then I came to identify that predominantly it has a succinct way of playing around what the market in a 500 pip range, right? So here you can see that we're playing around 1,200. It ran all the way up to 1,350, right? And then dropped all the way to flat around what 300, pushed in the midpoint of what 300, 350, ran all the way up to play on what 450, came back to tap on 1,400, went all the way up to what 150, right? You can see that pinpoints, it just taps on these 500 pip ranges that I'm showing you, right? 700 came all the way back to 1,450. So it is the characteristics of the market that I use to adjust the levels. But for the currency pairs, they act nicely on the 1,000 pip level. That's why I use the 1,000 pip for the currency pair. But the gold, the US 30, they don't act that way. They also have their own preamble, right? So you don't want to go to the gold chart and then be looking for 1,000 pip. You know you can get it, right? Because gold is like, has a crazy way of just trading, right? You can see, again, when you're following from the 500 pips that I'm telling you, from 1450 trades all the way to what was it, 1750, plays around 1700, blah, 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 jumps all the way to what, 2050, drops back to what level is it? Is it 1850 and pushes up? And then currently I'm expecting that it hits 1850 before probably we run back to 2050 and then we can see what a major downtrend for gold or something. That's just my long-term analysis though. But yeah, when it comes to gold, then you want to be looking at it in a 500 pip range, right? So you want to switch to the monthly time frame and then start. You may want to start all the way from the bottom, or you may want to start all the way from where we're trading. But I will only use what, a 500 pip. So 200, 1250, 1300, 1350, 14, just so on and so forth. That is just with gold, right? That is just with gold. So remember that all we're doing, we're still doing what, the top-down analysis. So you can see that I only write monthly support materials. It doesn't matter how you may want to label it though. The labeling doesn't matter. All you have to do is just understand what we're doing here in terms of the division, right? Understand what we're doing there. And then when we come to US 30, right? US 32, I use 1,000 pip, right? 1,000 pip. Not 1,000 pip range though, 1,000 pip differentials in terms of the price, right? So you can see here that I have what, 19,000, 20,000, 21,000, 22,000, and so on and so forth, right? So I use 1,000 pip price differentials when it comes to US 30, right? 19,000, 20,000, 21,000, 22, 23, all the way to 30,000. It also has a very succinct way of playing around these price points. That's why based on experience, based on research, based on back testing, then I decided to settle on what, 1,000 price differentials, right? So if I switch even onto the 8-hour time frame, you can clearly see how these market have been playing around these levels, right? It comes here 19,000, runs all the way up, pushes down to what level is this? 23,000, runs up to what was it? I think 2650 or something. Comes down to 23,000 again. Just so on and so forth, right? You can see how the market just plays around these psychological or round numbers, right? So I just like to use them as a basis to just see how the market is. So that's not only, I wouldn't call them like my entry criteria, but anytime the market comes around them, then I want to be interested in how the market plays around those key levels. Is it going to use it as a strong basis to reverse, or is it going to break through those levels, right? So US 30, take note of that as well, right? Yeah. So we talked about gold, US 30. I think NASDAQ also has similar thing, right? When it comes to NASDAQ, I do similar thing for NASDAQ as well. Also the same 1,000, right? So you can see I started from 7,000, 8,000, 9,000, 10,000, and so on and so forth. It was a very brilliant way of reacting around these levels, right? But it doesn't mean that like anytime it gets to these levels, it has to reverse or it has to push down something, right? But about, let's say, 60% of the time, it does react there nicely, like you can see here. Maybe 50. I wouldn't even say 60. Maybe 50% of the time. Here you can see what 11,000 it dropped, push back to 11,000 again, drop, right? Right. With these levels, right? Sometimes because here to here is 1,000 pip, right? You can adjust or put some horizontal ray anytime the market is trading halfway through it. Then you know that 500 pip. If you do that, then you have realized that you could be getting what 10,500, also acting as a key level, pushes up, come back to 10,500, right? But you get into that when you start the analysis properly, right? That is just about it. And then when it comes to DXY, I believe you guys know what DXY is. I use DXY to measure the strength of the dollar. So DXY basically represents the dollar index, right? The dollar index. The dollar index also, I use very different tactics to pick out the levels. based on how it has reacted on previous psychological levels as well, right? You can see all the way from 88.50. Let's see the price. Let's see the pip differentials. This one is not tradable, so there's no point in it. Give me a second, guys. Yeah, so when it comes to the XY, you can take a screenshot as well with respect to the levels, right? These levels have been on the chart for like only God knows how long now. And then some way, somehow, it does play along brilliantly. 15,000. 12,000. So 88.50, 98.50, that's a 10,000 pip. Then 98.50 to 108.50 would have been another 10,000 pip. But I just didn't extend it all the way there unless the market decides to trade in that range like it did here, right? You can see. So as far as the market decides to trade there, I would adjust my level. But now we're just dealing in this relevant range. Okay. I'll be back. Yep. Now that we know how to do our divisions, now that we understand these, like I said, I'm going to help you guys with it with respect to how to get the levels out. I'm going to give you the link to that group where I have I'm going to give you a link to that group where I have sent those pictures. Then you can follow that and do that. Somebody's asking about how many times support and resistance. We'll talk about that, right? Don't worry. Those are like you going way, way ahead of time. You want us to take things a step at a time, but you're asking something that's a bit further. So we'll talk about that when we get there. Okay. All right. So from here, then we're interested in looking at market structure, right? From here, interested in looking at market structure. You must understand that the market obviously doesn't trend in one way, which is like going all the way up or going all the way down, right? It moves in waves, it travels in waves, creating what higher highs, higher low formations, or lower high, lower low formations, right? So what do I mean by high high, high low formations? The market could be going what? Up, it pushes down a bit, goes up again, it pushes down again, goes up, it pushes down. Up, down, up, down. So basically, these are the three main market stages or market movement. Either is in an uptrend, either is in a downtrend, or either is consolidating. Right. So all the time, you want to look at the market from this angle, right? You want to look at the market from this angle. Either we're trending upwards, we're trending downwards, or we're going sideways, right? So as far as we're trending upward, trending downwards, going sideways, then you must understand what this is where certain concepts also do come in major play, right? Whether we're trending downwards, we're trending upwards, we're going sideways, there's a way to break the market down easily, right? So now let's take this a step ahead from point A. Let's say the inception of the trend, right? We start here, we move up a bit, some way, somehow, something stops us, reverse, but upon reversing or pulling back or retracing, right? You see, I use three terms. Either we're reversing, we're pulling back, or retracing, right? Reversal will actually be coming all the way down to the beginning. Then we see what the market has reversed. That's why I'm using dotted lines. All the way back to the beginning and say the market has reversed. But if it doesn't and it pulls halfway, right, maybe it gets to so here, right? Remember that what? Remember that if here to here is a whole move, we could call here to here what 100% of the move, right? 100% of the move, right? We could call here 60, here could be 70, 80, 90, 100, blah, 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 right? So if this market trades all the way to this point, we could say what it has pulled back what 50% of the initial move, right? That is the role of Fibonacci though, but we'll get into it. I'm just using this as a skeletal explanation, right? If it has pulled back 50% of the move, and then it continues up, but it has pulled back what 60%, which Fibonacci is basically when look at what 61.8, and then it has continued up, or it has pulled back what 78.6 or 70% of the move before it did what it continued up, and then what happened? It does the same thing again, pulls back, goes up, pulls back, goes up, blah blah blah, right? So we're looking at market moving in this kind of upward waves of what up and down movement. Now upon each up and down, it creates a new high and then takes the market up and up and up like that, right? But let's also investigate something here. So a pullback, let's say 50% of the move, or let's say even 60%, right? Here in this case, 61.8% of the move. And it start pushing up, it start pushing up, it start pushing up, it start pushing. It gets to what this point here, right? Something must stop this market from trading further up from this point, right? We do not know what, but for some way, somehow, that same thing could be a catalyst to reverse this market upon getting onto this point again. So here becomes what an interesting point where the whole world watches, including retail traders, including big players, right? Then you don't want to watch, especially on the higher time frame, right? The 4-hour time frame, the daily, the 2-hour time frame, whatever higher time frame you are looking at. Once the market is playing around a previous resistance level it had rejected, you always want to take keen interest in seeing if the market is going to trade downwards from that level, right? Or it's going to continue up. So there's always two sides, or there's always two ways to look at this, right? Anytime the market gets to a previous resistance level, you want to ask yourself, are we going to break this level and go up, or are we going to trade downwards and then reverse? You get it? But how are you going to know that? If we get here, once the market gets to this point, you ask yourself, now the market is here. How am I going to know if we're going to break up and continue up or we're going to trade downwards? That you're also going to learn and understand how you can do that. But I know, right? I know if the market is going to continue up or is going to reverse, right? For the most part, sometimes I may be wrong, but I'm right more than wrong, right? So once the market takes out this level, let's say in this scenario, it takes out that level. It takes out that level. It takes out that level. It can keep going all the way up. You may want to ask yourself, where is this market going to stop? You may never know, right? But sometimes you can know. It could be stopping from what probably a previous resistance that may have happened some weeks back, some years back, some months back. You may never know, right? So let's say it gets to that previous resistance, and then it starts to reject there again, start to retrace some portion of what. Now here's not a here's not 100% of the move. Here's the new swing point, right? This is what people don't get when it comes to Fibonacci. They always think that the inception of the trend is always where you're going to start from. This was what point A to B. A retrace. Now this, so let's say this is A, this is B, this is C, and then it pulled up to B, right? If you're measuring retracement of A to B, you start from point A to B. If you're measuring retracement of C to B, you start from what? Point C to D. You don't start from A to D and say you're measuring Fibonacci from A to D. You start from the swing point, right? That's why I said that my strategy allows me to catch trades at beginning of swing point or at the beginning of a trend. So what I mean by that is that if I say, okay, KOJO FOREX community, buy Euro JPY from C and then take profit is at, let's say, somewhere here, you are just trading the swing point. But if I say buy Euro JPY from A, you hold it to B, the next week again, I say buy Euro JPY from C, you caught the beginning of the trend, right? From the point A is the beginning of the trend, which also here was a swing point. There was a retracement in the swing, then the new swing point, there could be a retracement, then another new swing point, another retracement. For all you know, you still have what your A trade running as what's the trend, right? Which is what going through all the gyration of what the pullback up and down, but you still have your entry there. But if you catch in between those trends, you are just catching the swing points, right? It could just pull back, then you buy, or you pull back, then you buy, and then you pull back, then you buy, and so on, right? Sometimes I also trade the pullbacks, right? Or the retracement. Sometimes there are certain moves that I trade, then I know that I am just catching a pullback before I catch the continuation itself. Because the market is very random. A pullback can sometimes become an inception of a trend. It is a random market. There is nothing like surety here, right? Let's say this thing goes up, creates a new high, and I know that once it's dropping from here, right? If I try to catch a trade from here, it is me catching a pullback. If I try to catch a trade from here, it's me catching what? A pullback or a retracement. But this pullback could probably create a lower high and create a lower low and create a lower high, lower low, and then that would be a beginning of a new downtrend. So sometimes you may make your mind that you're just catching a pullback, but before you realize you're catching the inception of a new downtrend. So it's a random environment we are living in or we are trading in, right? As far as the market is concerned. But just get what we are still talking about here with respect to the structure. So we push down again. Let's say this time we make another retracement, and then we push up again. We're still going to ask ourselves, how's the market going to react here, right? It breaks this level, it hits another probably previous resistance again, and then it decides to reverse there, and so on, right? So as you can see, with all this up, down, then we have some form of a trend in the market, which predominantly is what? An uptrend, right? Predominantly is an uptrend. The same basis is what would happen for the downtrend as well. The market will start from an inception of an up, pushes down. So here again, here becomes what? Point A, here becomes what? Point B, right? And then if here's point A, point B, midpoint obviously is what? 50% of the move. The market could decide to pull back 50%, 60 or 70, 71.8 before continuing down. Once it's continuing down, we want to ask ourselves, is the market going to hold at this very bottom and then probably push back up, or is it going to break that level, right? So let's say in continuation of the trend, it did break that level. Let's say in continuation of the trend, it did break that level. It broke this level, maybe hit some previous support level again, and then started to pull back again. Maybe 50%, 60% of the move continue down, and so on and so forth. Then obviously you can see that there is also some downward reaction, right, or downtrend, right? So if you see my chart, you would always see that I have two lines, right? Two converging lines, one from the top and then one from the bottom, right? The bottom one measures what? The market support trend, right? Or support trend line, or I call it the support trend line. And then the top one represents what? My resistance trend line. So it's basically what? Opposing trend lines strategy working here, right? We measure the market from the top trend, which we expect the market to move up, down like that. And then the market from the uptrend, where the market is going to move up, down like that, right? So if you look at this, if you look at a typical scenario, a typical example of how a trend works, that way I've been able to track the market in two perspectives. Whether we're coming down, we'll be finding a trade there. Whether we're going up, we're finding a trade there. So I don't only look at just one side of the market, because it's a huge market we're trading, right? And then it gets to a point where now you become confused if we're in an uptrend or in a downtrend, right? Because the market can just jump up like this, come down, trade within this range like that, then dip all the way down, come up like that, and then dip somewhere like this, come down like that. So now you're asking yourself, are we in an uptrend or downtrend? The only way you can be able to tell that if you're using the way in which I look at the market, which is what? Drawing this what? As point 1, point 2, extend the trend line, or we're looking at what? Point 1, point 2, extend the trend line. That way, anytime the market makes a tap on this side, we know what to do, whether we're going to catch that trade on the downside and expect it to hit this level again, catch it on the upside, expect it to hit until it decides to break out of that range, and then we use market structure to determine, we adjust our points. You know, it's an evolving thing which you come to realize, right? But basically get a picture that way. So I always use that support trend line, catching the market from what point? Point on the downside, and then that resistance trend line, also look at the market from the upside. Right. So if you see two lines on my chart, one from the top and one from the bottom, that is what it means. Now let's typically talk about the market structure as a whole. So with respect to what we've been doing, where you see me creating that high low formations, right? Let's say here we go up again. Here we go up again. We trade. So here we're confused, right? Once the market trades above this level, right? Once it closes, there's a strong body closure above this level. It signifies that this level didn't hold as a resistance, and then potentially we could push more, right? So here we can see what we're continuing in that uptrend, right? It hits this another level, it pushes down, it retraces a bit, and then it continues again, it breaks this level. We say we're still continuing the uptrend, right? Let's say it retraces again, it pushes up. This time it fails to trade above this one here, right? It fails to trade above it. Then it starts to push down. Then we can start suspecting that that uptrend could be coming to a halt, because it's been creating high low formations, and now it's creating equal highs. Why? Why is that this time it didn't trade all above and continue? Because the bears are trying to show their presence, right? But creating equal high doesn't mean the trend has changed. Why? Because this is a predominant low or significant low in the market. This is the last significant low in the market. Yeah. And then for the market to change its trend, it needs to take out this last significant low, right? How will it take out that last significant low? Unless it comes to what? Trade beneath it. And upon getting here, right, the market could also sit upon this level again as what? A support and then continue the trend, right? That becomes the tricky aspect of the market. So all you may think is that, okay, here could be what the trend line, right? We could break the trend line, but we will not break the market structure. You get it? So here the trend line could have been broken from here, but the market structure is still intact, and the market structure could put the market back into what? A trend, and then the trend will continue, right? I've seen that happen several times. Right. So the only way, like I'm saying, that we consider market structure broken is when the last low, which is here, last previous low, which is here, gets taken out. Let's say we trade downwards beneath it, then we can confidently say what the bears have shown significant sign of what taking control in this market, and then what we could make what a lower high, and then lower low, and then the bears will just continue like that. In the same vein, when the bears are trying to lose momentum, what happens is what the market will push up, push down, right, and then maybe fail to break this last low here, right, and then it start pushing up. That way, the only point we can see the bulls are predominantly also looking to take control in the market is if this last low, lower high here fails to be taken out, right? So we trade up to get to this point, and because here the market could just act there as strongly as it could be and then continue all the way down, right? But we could say we are confident that the bulls have taken control if the market gets to that point and what trades above that range, breaks that last high there, and then we could expect what a lower high to be created, and then you can see that eventually it just what run in what a cycle of what accumulation, distribution. Equal low, equal high, equal low, equal high, equal low, and then what at some point it just veers off from the range and then continues like that, right? So you have to understand all these cycles to be able to understand, to be able to what, just see the bigger picture of how the market plays. So you can see that I basically run you guys through how the market can change trend from an uptrend to a downtrend and then back to an uptrend, and then the same thing would happen back to a downtrend, right? So all the time, it's not that the market will only use what equal highs or equal lows to change trends. Sometimes it could use what lower highs, right? Sometimes it could use lower high. How would the market use a lower high to change a trend? Let's say just like this one. Just like this one, it pushes up, it pushes down, it pushes up again, but it pushes down. This time, let's say upon pushing up, it doesn't get to these highs here. And then it hits some points and then it starts what reversing, right? You can see that it is used a lower high instead of an equal high. We'll still be interested in seeing how the market will react here, right? Because it could just get to this point and again what continue the trend up, or it could get to this point and then break down. So in change of a trend, we always want to look at what the market either creating what an equal high or a lower high, and then our points of interest will always still be what that last what support level before the lift off, right? Once the last support level gets taken out, before we can what start to adjust our bias or think through the market. So with this being said, explain